Begin with introductions. I'm Deputy Helen Miles, Chair of the Corporate Services Scrutiny Panel.
Deputy Jonathan Renniff, member of the Scrutiny Panel.
Constable David Johnson, member of the panel.
Deputy Alex Curtis, member of the panel.
Elaine Miller, Minister for Treasury and Resources. Apologies.
Richard Bell, Treasurer.
Richard Summerskill, Controller of Revenue.
Cora O'Brien, Deputy Controller.
Andy Hack will be Director of Strategic Finance.
Lovely, thank you very much. I'd just like to draw your attention that we've got 2 hours scheduled for this meeting. Therefore, we can begin, and I'm going to hand over to Deputy Renniff to ask the first set of questions.
So the Fiscal Policy Panel said that in 2024 the government ran an operating deficit, and 2025 the budget is being bailed out by withholding money from the Social Security Fund to the tune of £50 million. Do we have a structural deficit, Minister?
We have had operating deficits in recent years, and I think because spend is exceeding revenue growth, it could become structural unless we do something to address it. Now, something to address it could either be increasing revenue by raising tax, which nobody wants to do, or by reducing spend, and that is what we are trying to focus on.
So the structural deficit argument would be that we are relying on a short-term funding measure for the next 4 years to fund long-term commitments in health and education and so on. In what way would you say that avoids being a structural deficit?
Well, I think there are other things, and we do need to look to grow the economy. We do need to look to grow revenues by revenue growth. The issues have also been that we have put more money into capital. So the combination of capital and depreciation is also part of the issue. So those are all things that have to be considered. So there is work to do, and the future government will have to consider some of that to make sure. But you either raise revenue or you reduce spend, and that is either of those things are not necessarily easy.
So in terms
we are forecasting, I think we are forecasting later in the plan revenue increasing. The period we're going through at the moment will improve. We are reliant on we are reliant on financial services to a very great extent in terms of economic growth and contribution. The work we're doing with financial services on the competitiveness programme to make sure that continues to thrive and grow will also produce benefits, although not necessarily in the budget. But we do have a programme. We've talked about it several times at Council of Ministers in terms of how we reduce the size of the public sector, which has got out of control. And it does require everybody to bear that in mind, because nobody ever brings a proposition requiring us to spend less. Every proposition that a backbencher brings involves spend, even when it's business as usual. Officers can do it on the side of their desk. The officer doing it is then being distracted from something else. So, it's very difficult when we are constantly getting propositions requiring us to spend money or to create new bodies. Every time you create a new independent body, you create a potential for vastly increased costs, and all of those things. We have all, as an assembly, got to start facing up to all of those things and thinking about the impact of the propositions that we bring.
So we ran an operating deficit in 24. We're doing the same in 25, effectively. How does the Treasury define what is sustainable? Because presumably you would accept that is not sustainable going forward.
Treasurer, would you like to help on that?
So we would expect, and indeed required, to be able to balance the books across the period of the plan. Each of those successive budgets does have a plan in place to balance the books. The challenges we have, and the challenges in particular with this budget, where whilst income will still increase, it won't increase by as much as we'd previously forecast. Higher inflation has increased the expenditure forecasts for government. So the plan has changed between years. It still says that we have a balanced budget over the period of the plan and into those future years. Take the points about the changes to the Social Security grant, but the Social Security Minister will be undertaking the actuarial review and then a review of the position of that fund. That fund is in rude health. So if I take talking about sustainability into the long term, we have good reserves. We may have recommendations from the fiscal policy panel that the strategic reserve should be larger, but the Social Security reserve is a little bit above the original intent of the size of the fund. So in terms of long-term resilience and sustainability, we're in, or the states are in a relatively good
Yes,
place.
but the fund is only sustainable at that level if contributions restored, and the current plan is to take money from the contributions for 4 years, and that's it.
Yeah, but that
So
is,
after that, money will have to be found from somewhere else to close these deficits.
that is still a temporary measure, and we believe that will not affect the long-term sustainability of that fund. And in the meantime, we will be looking to reduce spend and look at how the as
Okay,
financial
so the
services
plan is to cut
ticks up.
spend to close that gap in the meantime. With
Sorry?
the aim is to close the gap by cutting spending in the next 4 years so that you won't have to rely on that. Okay. Can I come at this from another point of view then, which is that you're using £50 million from the contributions. How did you decide on that figure, Minister?
Treasurer. Well, I think because that was the money we need to balance the books.
Okay, so you did not look at the fund and think, this is how much money the fund can afford to lose. You looked at the budget and said, this is how much
The
we
fund
need.
is in very strong health. It has over £2 billion in the Social Security Reserve Fund. The actuarial reviews, which were published in 23, show that in a variety of situations, the fund is sustainable well into the 2080s. That it is secure, it is continuing to accrue very good investment returns. It is continuing to grow, and we've got graphs that show that it is continuing to grow. And if you have a choice between, you know, the idea that we just go, oh, let's just cut this grant without thinking about anything else, the obvious things are increased tax, increased contributions, or cut spending dramatically. Nobody wants to do that.
I'm still trying to get to this 50 million. The 50 million, you know, why 50 million? Why not 60 million? Why not 80 million? Why not 20 million? What was the choices that made you choose 50 million?
Because I think that's what we need to keep her to balance the books.
The need is relative here, isn't it? Because these are all choices. Choosing to increase money,
Yes.
going into certain
Would you like us
places.
to increase tax?
I'm
Who's
not-
going to vote to
I'm-
increase tax?
Minister, I'm asking you why you made the particular choices you made.
Because because it was the best option. Because the options are, if you have a shortfall, the options are to increase tax dramatically or to cut spending dramatically and actually say, no, we are not going to put more money into health and they will have to stop providing services and we will create waiting lists, or we will stop providing school meals, or we will stop providing other services to the public, which will not be acceptable to the public or to politicians, or to take money out of the strategic reserve, which the FPP tells us we shouldn't do, or to reduce the state's grant on a temporary period.
But Minister,
You know, these are all things that are considered. We don't just pluck things, and you will recollect that because the state's grant was also proposed to be reduced in 23 and 24, and it was reduced in 22.
By 20 million with a promise to repay it, somewhat different to £250 million, which isn't going to be repaid.
I think Deputy Renniff's question about cutting spending and the short-termism is, your response was, we need to bridge that gap within 4 years, as this is a temporary measure, and these are choices. So why couldn't the choice be made now to make those choices about the level of spending need, to say 50 million is a lot to come out, or may not be, but you know, we don't need the budget to be, we could cut our cloth earlier than in 4 years' time. Because it feels like
cutting by £50 million in a year.
I didn't say the
don't know
whole
how
amount,
we would do that.
but you know, the
I don't know how we would
choices.
do that.
It sounds like that that shortfall has to be met within 4 years to meet what's being put forward as a temporary measure.
And
And
in
so
over-
that's not a long time. So it's trying to work out where these numbers came
Over
from.
that time, they came from the accounts. They came from what our financial accounts are telling us.
But what we're choosing to spend as well.
We're choosing to spend. Well, we're choosing to spend because what was the alternative? That we don't work. That we don't do drains and roads. That we don't do the fort. That we don't do. That we stop providing services.
So
that
what-
we don't build children's homes.
What provides
for
you
vulnerable
confidence that in 4
children.
years' time, the answer will be different, that we will have found ways to deliver savings without that compromise that the public might have to accept? Because if nothing's acceptable to cut right now, what will be different in 4 years to give assurances that
In
our funds
4
will be
years,
stable?
You're looking over that period as to how well, if over the 4 years you cannot reduce the spend, which is what everybody's telling us they want us to do, the public, I have no doubt, if you stopped them and said, how would you feel about paying more tax? They will say, no, stop spending first, stop wasting our money. And until the public are in a position where they think we are not wasting their money, nobody will accept tax increases. So there is that period where we can, now if you can't reduce spending in a way that is acceptable to everybody, including politicians, then you would have to look at whether, what else you do to increase revenue.
Well,
And that has its own issues for the economy.
but so what you're saying is that there's lots of good stuff we need to spend the money on, health and so on, great. But why stop at 50 million? Why not 60 million?
Because we don't need to 60 million.
So no minister would have wanted to increase their budget.
What we've tried to do
So,
is stop the growth cycle.
go on, sorry.
By
You know,
increasing.
you will remember in 2023, the government plan process in 2023 involved dozens and dozens and dozens of growth bids, which involved tens of millions of pounds of additional spend. And I can't remember the number, but I do recollect it being in the region of 600 new headcount. We are not having that growth process anymore. There is some new spending, and the new spending has been limited to CSP priorities. So things like the children's, the new children's homes, which are essential, and to areas where there's a risk factor, or where we think which children's services there is a risk factor. But we're not saying to people, government plan time, come and ask for new money and see what happens.
But yeah, okay. Well, let me come at it from a different point of view, which is two ministers have told Scrutiny that they would have rather seen the £50 million because it is not recurring as a source of funding spent on capital projects, which are time limited and therefore more suitable for a temporary source of funding. Why did the government not choose to do that?
Well, we will be investing in capital. There is capital
The
investment.
budget says very clearly what the 50 million from the Social Security grant is going on. It's going on health, childcare, more police, so on.
Yeah.
But there is
But there
increased
is
capital
increased
investment
capital
over the
spend
period
as
as well.
well.
Yeah. Well, the ministers said clearly that they thought the money should not be spent on recurring expenditure. It was the Minister for
Well,
Economic Development and Minister for
I don't
Infrastructure.
recollect that being discussed at COM.
Or in which case I'd ask you, what is your opinion about that?
My opinion is that we clearly need capital investment, and we are investing money in capital improvement, in infrastructure, in the fort, in the hospital, in the drainage systems, which we are crying out for. We cannot build more homes until we've sorted out the drains. We have to do that spend, but we also have to deliver revenue spending. Or we don't, and we just don't do it.
Yeah.
We don't do revenue spend, and we just say these services will not be provided.
I think the money.
But everybody wants services provided as if we were a very large country.
The question is, the government has hit on a new source of funding which hasn't been used by governments previously, except in a tiny, tiny way.
It has been used by government for quite some considerable time.
Reductions in the grants, Social Security grant, are a new feature. They were
Back to
voted out.
2014, I believe, 2014
They
and
were
2015.
emergency reductions to do with COVID and so on. But
I
as a,
think
me-
prior
as a
to
measure of
COVID, I
finance,
believe prior to COVID, there were reductions in the grant.
the,
But somebody could confirm that. It is not new.
the,
We are putting money into a pot that is already very healthy. And it's like putting, as I said before, it's like putting money into your savings and then not being able to pay your
there was
electricity
no
bill.
calculation on how much money the funds could afford to lose before you hit on that £50 million figure. The £50 million figure derives from how much you felt you needed to find, rather than a calculation of what the Social Security Fund could afford to lose in contribution.
The fund is very, very healthy. It has over 2 billion. It is forecast to grow, and I don't have the numbers right in front of me. It is forecast to grow by 0.7 of a billion, I think, over the period of the plan. That number is. It is forecast to grow over the period of the plan by 0.7 of a billion.
Depending on the assumptions that you feed into that. So,
And the assumptions are that it is very healthy. It has the returns. The returns have been above target on 5-year, 10-year and 14-year periods by over 3%. The target return, it has exceeded, not at 3% every time, but at 14 years over by 3%. It is forecast to grow.
don't they say past performance is no guide to future return?
But it has done very, very well. It has continued to grow. It has grown even in periods when it was not receiving the full grant per the original formula. And I think we have to remember that this fund was set up a very long time ago, and that the nature of the Social Security Fund and what it provides has changed dramatically. And I don't think it's unreasonable that at some point somebody has to sit down and say, is this fund working the way we want it to fund? Are we over... it's forecast to go up to almost over 3 billion, between 3 point.
Might it not have been handy to do that before you decided what money to
We did do it.
take out?
We did do it. These haven't been retrofitted. We did this information was all available.
It was based on assumptions of increased return, which are now being looked at again, as we've asked the Social Security Minister to do that. Can the
And
Okay,
it will
if we
be
move
based
on.
on actuarial reviews, which will look to the term. The last actuarial review of this fund said it was in very good health and it could continue to pay benefits for a long time on various immigration scenarios.
Has the Treasury planned for a low profitability scenario in the finance sector? In other words, if revenues continue to underperform, as the Treasurer pointed out they had this year, what planning is there, given that the Social Security Fund has now been used as a source? What other contingencies are there if resources do not match what are expected? What are the contingencies?
In terms of in-year contingencies, they are within the plan. £5 million contingency against expenditure, which is an historically low number. We have also contingencies in place for pay, so pay is provided for. If you go to other parts of the world, you don't necessarily have pay provided for within central budgets or on top of central budgets. They have to be found from departmental budgets, so there's provision there for those. We have mostly provisions that relate to expenditure rather than income. What we have said, and it is said within the budget document this year, is we think that we're convinced that we need to move back to 3-year plans so that you have in place contingency across the 3 years. Departments know their budgets for 3 years. Those in receipt of funds from those departments know what their budgets will be for 3 years, and you therefore have to build a bigger contingency, as we used to have in place, against income fluctuations across the 3-year period.
What is that contingency, that bigger contingency against income fluctuations?
So we used to have a bigger contingency within the Consolidated Fund that has been spread across a number of governments, and in particular has been considerably impacted during the COVID years. Whilst we did borrow during COVID, we also ran down the size of the Consolidated Fund rather than borrowing increased funds as we came out of COVID. Rather than maintain that debt in place, we used the balance on the Consolidated Fund. So that level of shorter term contingency is not what it has been historically.
So we don't have much contingency if income continues to underperform.
Obviously, on a year-by-year basis, that's easily dealt with, or relatively easily dealt with, comparatively, by adjusting the budget. We'd rather move back to a system in which you reset the finances, have a contingency amount, and you give certainty to departments.
Okay, so you, sorry, do you want to move on?
No, that's right. I was just going to note that Deputy Gorst had joined us just for the
Okay.
purposes of the
Yeah.
recording.
Thank you. Sorry I was late, Chair.
One of the signature features of the budget is the creation of the Jersey Capital Investment Fund, with the aim of insulating capital spend from short-term spending pressures. How are you going to achieve that, given that, for example, the Social Security Fund contributions, which are also protected in law, have been used in this budget? What is going to be different about the Capital Investment Fund that will prevent it being raided, just as it has in the past?
Well, that is the idea, that by setting up a fund that is kind of ring-fenced for investment, it's not raided all the time, because that's been one of the previous problems, that instead of investing money into capital, we move it into revenue spend. So by setting up the fund will be established. We will have to bring forward legislation to establish the fund, to set out its terms of reference. It is underpinned by a 25-year long-term capital plan, which the Treasury team have been working on for some time. That's been one of their objectives for some considerable time, to look at how we invest in capital in terms of what we need, what capital do we need to maintain what we have. I think, does depreciation come into it as well? How we pay for depreciation? It's about maintenance and building.
So depreciation is one of the ways,
Sorry.
because we balance the books after depreciation. That provides one way in which you would provide for capital. But what we found, as you look at the long-term capital plan, is the actual need for investment to maintain the assets, even in their current state, to provide the services that they currently do. Depreciation isn't enough, and that's why, or part of the reason, that the consolidated fund has reduced from the levels it was previously down to a lower level now. The move to the capital investment fund, one of the key ways that it protects capital is through the transparency. So if you have a long-term capital plan which says you should be putting in, let's use a hypothetical number of 100 million a year, if subsequent governments choose not to put that 100 million in, they are effectively saying we are choosing to under-invest, I use that word reservedly, in our capital for this period. They would have to have a good justification for doing it. So that transparency makes it very clear. To take to your point on the Social Security Fund, it currently has 7 times expenditure. It is, as the Treasurer said, slightly higher than the original target for the fund it was. So therefore, you can look at it and say, well, actually, the justification for not putting as much money into that fund because of these pressing needs. Future governments, you can't tie the hands of future governments entirely, so they may choose to put less money into capital, but that would have to be for good reason, and that transparency means that they would be justifying why that was the appropriate thing to do.
So it's transparency that is the signature.
There are other things as well, but I think that would be one of the key ways that it would be done. It would be very clear that that's happening.
Does the Treasury, do you, Minister, prefer the idea of a 3-year budget cycle rather than the single-year cycle, on the same principle that you are making commitments that are harder to break?
I think the 3-year cycle, I think will make it easier for officers to manage their budgets over the 3-year period. And we won't have we got an underspend that has to be rolled over. It will make it easier for officers. It means that we should not have people coming in every year asking for more money, because people are being asked to look at a medium-term view. It will make life easier for everybody. We have the budgeting paying once every 3 years instead of once every year.
Is that the plan going forward, that we will only have a budget? We'll have a budget for a new government and then a budget the following year, and then that's it?
We'll have to work through that.
Okay, we're working through
understand
that. So then, therefore, there were disadvantages to the way that it used to work with the 3-year budgeting. What we're trying to do is work through the pros and cons of both models. We do think that you would have an annual budget in the sense of setting your income plans, but also that might also be the tool through which you would adjust your capital plans. And that's merely about phasing of capital rather than reducing funding. It's just to say that's what we used to do. We used to come back every year with a change to the capital plan in addition to the income raising measures that underpin that 3-year financial plan. So we'd see that there would part and parcel of it would be to come back at some point. Whether that is about capital, I don't know. We could build the flexibility into the 3-year plan. But what we're saying is for departmental revenue spend, the current system, whilst you could say that the aims were to have 3 to 4 year budgeting, the current system as it is in legislation means that it drives people towards wanting security of growth in the first year rather than a 3-year plan over which any growth available could be deployed, for example.
Is there a timetable for bringing forward proposals? Is there a timetable for bringing forward proposals
So
for changing
we have
budgeting
2 phases of
processes?
the changes we are looking at. The first will be the Capital Investment Fund, which will be available
Before the election.
to be decided before the period of election sensitivity. The second phase we will be working on is working through how we see the pros and cons of the 2 models, having experienced the 2 models, what we would propose changes would be, in, not just in terms of the legislation, but in terms of how it would work in the background through the finance manual.
Final one from me. Are there any plans, reviews, or any similar kind of work going on to try and broaden the tax base beyond Pillar 2, which is obviously so there's no government intention to try and broaden the tax base, for example?
I think that could be very counterproductive. I mean, Jersey's reputation relies on its tax stability, and as soon as we start changing tax, we would have to really need to do that. And the bottom line is we are still spending more than we should. Or we are spending a lot of money that we need to try and rein in. But I think if we start, you could say you either tax everybody more, which will not be popular, and if you say we're just going to tax the wealthy, that would be utterly counterproductive because those people are very mobile and would not stay in the island. And it creates a reputational risk, and we've talked about this a lot with people. Jersey's reputation is for stability, and when we start changing the tax system, that will affect that reputation for stability. So for me, it would be a last resort.
There are things to like.
And I don't think the public would accept it anyway because they see wasted funds.
I would like to stay on some of the strategic elements of the budget outside of year-on-year expenditure. And part of the budget commits to or assesses kind of some of the longer-term fiscal planning. So to start with, part of that is around understanding long-term costs, long-term fiscal pressures. So within 2025 and part of the budget preparation, what work was done in assessing health, social care, pensions, the kind of some of the longer term fiscal pressures that we're aware of and our sustainability risks to our budgets?
Well,
So, key piece of ongoing work that is fair to say at this point more in partnership with Healthcare Jersey, Health and Social Services, is the piece of work around future costs, future sustainability of costs for the health service. So we've been working, there is a ministerial group that overlooks that, which the Minister is a member of, with the Minister for Social Security and the Minister for Health and Social Services, to look at what those future costs are, to have an agreed position as between Treasury and Health as to what the current cost requirements are and what their impact on the state's finances will be. Some of that work has informed a position for increasing the amount of money over and above that which we have previously provided at 2% above inflation to, in practical terms, 3% above inflation for the 1 year whilst that work progresses.
Okay.
So that's one example. The other example would be the advancement of the long-term capital plan. That underpins lots of what's within the Investing Jersey proposals and within which, of course, we've got the Capital Investment Fund, as we just talked about. That for the first time, will give us a plan over the long term based upon not just the usual things you might base that upon, but also about demographics, particularly as it might affect the school estate, but also in terms of the current condition of the estate.
So, health for a start. Page 96, so near the end of this, financial matters under development, sustainability of health funding finds itself pretty much by 2 pages from the appendix. We've known there's a pressure there. Subsequent budgets have always recently applied above inflation increases to health to address that. Why in this budget is it not taking, apart from the fact that it is taking a pressure on the immediate budget, and Deputy Reniff has touched on, and we've touched on, obviously, the pressures on revenue over expenditure over revenue. Why does it not take a more pressing position within the budget as a strategic risk?
Thank you for confirming it is in the budget document. This is the budget for 2026. That work will aid the Council of Ministers of the time of the government and the Assembly in forming a view as to what long-term funding looks like, as opposed to the funding for 2026. But it is in the document, it's a priority that we're working with the health team on.
We've had a position for some time where health have an uplift. Everybody has a kind of inflation uplift. Health's normal uplift is a little more than inflation, but it would transpire. And that was something that was agreed with them, I believe, some time ago. Health said this is what we need. And we are not alone in this. The health costs are because we have a more ageing population. People have more complex needs. There are more treatments which are more expensive. The cost of tertiary care that we're having to send people to the UK is increasing, and the uplift isn't sufficient. So, and the UK are seeing exactly these pressures as well. So there is long-term work ongoing.
They're well established problems. The requirement for spending is, or the requirement for service is well established by a lot of people. It's just trying to work out how much priority is being given to assessing the position, and working out where, this budget is for next year, it's 2026, but it's to 2029 as well. So the fact that we find it on page 96 does feel a bit kind of acknowledged, but not necessarily assessing the severity of the issue.
I think it is a priority. It's clearly a priority.
Added to which, of course, this budget does, as well as funding to deal with current pressures and additional inflation within the budget, does prioritise within additional funds, whilst, let's be clear, healthcare spending will continue to go up. The advice is that increased investment in preventative measures will hold down those future costs, as well as improve outcomes for patients, of course, and the investment in health digital is aimed towards creating greater efficiency and effectiveness in the service as well, which also helps mitigate future cost rises.
Health sustainability funding's there in matters under consideration, pensions and social care less so, I would suggest in the narrative. Would you consider they are equally areas of priority for understanding the long-term sustainability risks to our funding models?
Well, we know pensions, I do not believe are at risk. As I've said, the Social Security Fund can pay pensions into the 2080s. That was what the last actuarial report said.
I do want to touch on that one more time because...
So the Social Security Fund, in terms of pensions, we have to remember the Social Security Fund is not just about pensions. It funds a whole range of other benefits. It's an insurance scheme. People don't have their own personal pot. Long-term care, we are aware that fund needs topping up, and there is a proposal to do that. But long-term care is more work I think will need to be done in that in due course, and I think that is the two ministers are looking at that.
I don't want to visit Social Security too much more, but is it fair to recognise that the fund may look in good health, but the same actuarial reviews that provide the positive narrative for the budget to take the money also show that if we are to maintain payment expenditure, with contribution rates, every scenario pretty much requires an increase in the contribution rate from the
Which fund are you talking about?
Social Security and Social Security Reserve. So
I
to
don't
meet the long
think- I
term,
don't think
pretty
those
much every-
my recollection is that they do not require.
to meet projected break-even contribution rate to expenditure in the last actuarial review, pretty much 3 out of the 4 scenarios, all but the net 1,000, do require an increase in contributions pretty much from 2027. So, I mean,
It's not my
the
recollection.
So,
I think the long-term care fund, which is a separate fund,
long-term
will
care
need
is another
additional
position, but
contributions.
So,
from memory, the break-even contribution rate doesn't, and I would have to go and check this, so it might be something that we follow up after the meeting, doesn't necessarily take into account investment returns. So you were setting a contribution rate which assumes you have no reserve and can't use investment returns to supplement the pension payments. So it's a slightly different number that's calculated compared to, so we're very lucky. We don't need to put up contribution rates because there is that reserve. Investment returns help to defray some of the costs of pensions, which was always the intention. The original proposition back in 1996 expected the fund to go up and then be drawn down. I think drawdown should have started before now. We've been lucky with investment returns that the fund has grown greater than originally envisaged. So I think the key question, and one of the things the Social Security Minister will ask the actuaries, is what are the options for the Assembly now to look at how we use the Social Security Fund moving forward? And indeed, the Fiscal Policy Panel have said we should review the objectives of the fund because we're not in the same position we thought we would be. So what is the best way to make sure that we're safeguarding pensions, helping intergenerational fairness, trying to smooth the impact on contribution rates if that's required, and there are. But that the actuary's work needs to happen to do some of those for that wider conversation. But I think that the next Assembly will have all of that information to allow them to make some of those longer term decisions.
okay. Turning to another part of the strategic element of the budget and Treasury's function within it is, Deputy Renniff touched on kind of the tax base, but it's about economic diversification, and it's understanding what work Treasury is doing in thinking about the long-term fiscal planning in economic diversification to mitigate economic shocks and kind of the impact to your revenue.
so we would do the plan beyond the long-term capital plan is to also move to working with economists to look at the longer term, not necessarily longest term, revenue expenditure pressures as well as the forecasts as well. That would be based upon work that's already been done, previously published through the Economics Unit, where they've looked at those long-term pressures as they affect, I think as they affect income as well as, top of my head, as they affect income as well as they affect expenditure also. So those are laid out in terms of very long-term estimates made, forecasts made through the Economics Unit. We work closely with the Economics Unit. Treasury is not directly the department responsible for the economy, but we do work closely with those departments responsible for that, including financial services.
Okay. One or two more things from this section of the budget, which is the financial matters under development. There's a phrase in here regarding the longer term planning function, which you've just mentioned. And the final paragraph says it is anticipated that the development of these models, being the short, medium and longer term models, will be a multi-year project drawing on existing work to eventually incorporate all aspects of government finances into a holistic model. Could you explain a bit more about what the current plan is, what the holistic model kind of refers to, and what Treasury is setting its sight on when it says this is work under development?
Do you want me to pick that one up, Richard?
Yeah.
So I think that is a lot of this is very complex. So the idea is to build the model in stages. So the first stage would be to look at what we currently have as the consolidated funds. So what are departments spending? What's the tax revenue that come in? You've then got other elements which are very important to overall government finances, such as the Social Security Fund and the money they spend, long-term care fund. Those are likely to be added in subsequent stages. So as the actuarial review completes, you will then be able to feed in what the actuarial review is saying into the model as well. So that as well as just looking at, here's our consolidated fund and this bit of government, you'd look at everything that is incorporated in all states funds. Most other states funds are relatively modest, so, you know, are less impactful, but social security funds is the biggest one that would be added in.
Okay. And it says that work is expected to be undertaken in 2026. What's the expectation at the end of 2026 as to the maturity of the different models that you're developing for short, medium and long term?
So the intention is to have an initial model, certainly for the consolidated fund in 2026 to inform the next budget. However, it is very complicated. So there may be elements of that where we've taken a more simplistic approach. So as we develop the healthcare funding, that might be a bit more sophisticated. When you look at other departments, it might be broad assumptions like tracking the economy or tracking population. As we get more detailed information, you could add in what we actually think the trends would be in those, which means that the model will become more and more sophisticated as time goes on. Okay. So that's what we mean by multi-year approach, is that we'll get something, but then we'll continue to improve it as we move forward to help inform subsequent budgets.
We might follow up on questions as to kind of specific timeframes and expected delivery.
Thank you.
Yes, thank you. And move on now, please, to some general questions on the general revenue and your budget proposals. Starting with the level of engagement, if I may, can you confirm, please, or outline the level and approach of stakeholder engagement in developing revenue raising and relief measures for the budget, including key findings from such consultation with stakeholders and how they influenced the ultimate government decisions?
Well, we do follow a programme of engagement, and we write to various stakeholders in March every year saying, would you like to make representations about changes, about things you would like to see? We consult with them about proposals that we're bringing forward. We speak to, so the likes of the Jersey Hospitality, the Motor Traders Federation, the FSG, what does FSG stand for? Fiscal Strategy Group, which are from the tax agents and legal profession. We go to them, we discuss with them, who are experts in the field, and we take their views. Now, they may sometimes say, well, they consulted us, they ignored us. That we have not necessarily ignored them, but you cannot always give people what they want. For example, Jersey Hospitality, I think, would like us not to charge any duty at all on alcohol. That's not going to happen. And it's not that we're ignoring the request, but it's just simply not deliverable. So we do an extensive consultation. Who else have I missed out?
Well, we have a number of standing stakeholder groups that meet quarterly. Cora chairs one on tax policy, where I think the budget measures are always discussed.
Yeah, so the other people, so Jersey Farmers Union, some stakeholders don't come back to us, or they come back to us when it's simply too late for us to do anything. And they come back with things that we cannot deliver. We cannot deliver something for workers in agriculture that you can't deliver for workers in hospitality. You know that, and there are some things that you simply cannot do. But we do engage and we do hear their views.
That was my question about level of engagement. I mean, I presume that your span of stakeholders covers the whole field, I assume, in all areas.
I think it does, yes.
And following feedback, you do continue to engage.
Yes,
what I get at is how intrinsically engaged do they feel, as it were, at the end of the day?
I would say that some stakeholder groups are more likely to engage routinely than others. Probably the most active stakeholder group is the Fiscal Strategy Group, which covers accountants, lawyers, representatives of the trade bodies in the financial sector and so on. Farmers Union, for example, tend to approach us on an issue-by-issue basis. So it really does depend. It also depends to some degree on the extent to which different sectors of the economy do have a representative body and do have standing officers in that body that can engage with us. Otherwise, it's very much on their side down to voluntary engagement.
And once these are in place, I mean, what steps are taken to ensure that the stakeholders, what measures, what is the monitoring of those measures to assess their impact on island businesses once the go has been given?
I mean, it does depend on the measure. If, for example, we were introducing a new form of taxation, there would be a process of post-implementation review about how well we actually implemented the measure. But in the longer run, there would be a policy evaluation, which would try to establish the extent to which a change of policy had been effective. We don't tend to do those very often unless it is a significant change. So, for example, Pillar 2 will in due course have a policy evaluation review. The vaping tax that's coming in this year will probably, with health, keep monitoring the impact of that.
Thank you. And turning to the question of exemption thresholds for personal taxation. How have cost of living pressures been monitored in 2025, and how was it decided that the proposed increases would effectively support low-income earners?
I think that is more for the Minister, perhaps. I mean, obviously, the increases are below inflation, so I think the Minister has definitely...
Sorry, my question before that is what approach was taken to determine what the exemption levels should be?
Well, we have considered that, and we look at what I think we have to remember, I do have to keep emphasising that our personal tax threshold is significantly more than anyone else's. You know, it is 21,250, the UK 12,570, and Guernsey 15,200. That tax allowance keeps money in people's pockets. That will definitely help low earners. We could have decided to do we could have saved some money and done what the UK do, which is they have not increased, some jurisdictions don't increase their personal tax allowances every year, which means that the benefit of that exemption erodes. We have maintained ours. We have continued to increase it. That ensures that Jersey will remain competitive, and that will benefit lower earners, and it will keep some money in their pockets. We've also introduced the child tax allowances, which people with children will benefit from those. So those benefit lower earners. There's no question about that, I don't think.
And concentrating on the low-income earners for the moment. I mean,
yes,
it's obviously a Treasury decision. Assuming you have engagement with your counterpart in social security,
yes, we do, and cost of living. I mean, I think we have to, we look at what inflation's doing, where the cost of living group meets. We also have to, the things like the community cost bonus was increased. It was doubled in 2022, and it has never been reduced. It has been maintained over £500. The minimum wage has gone up very significantly, and I did ask for figures from that, but I don't understand the table. But the minimum wage has gone up by significantly more than inflation. So we are aware of that. The Cost of Living Group have agreed to do minimum income standards, do some work on minimum income standards, which will help in future. But we have considered cost of living, and that is why we have agreed, we decided to increase the threshold rather than leaving it static, and 90% of taxpayers will benefit from that, the increase in thresholds, but it will particularly benefit low earners because it means they are paying even less tax.
Okay, changing tax slightly from onto excise duties. Can you provide an update on the monitoring of the impact of freezing or reducing duties on alcohol, fuel and tobacco from 2023-25, including any observed trends?
Richard? Well,
I don't have the data with me, but I think consumption of alcohol continues at pretty much the same levels. I think what we observe is that overall the freezes have helped slightly. I think Jersey Hospitality and others in the industry would still say that they could do with more help. Obviously...
Is that being considered?
I think it becomes increasingly difficult to freeze alcohol duties. They've been frozen or lower than inflation for several years. So their real value to the exchequer has kept diminishing. And I think this year we're broadly returning to longer run policy. And obviously if one continues to uprate the personal income tax allowances by inflation but doesn't uprate things like the excise duties and the wider impo, then you do start to create a structural imbalance.
I think there are further questions in that area later, so I'll leave it at that. Thank you.
Thank you. Yes, just moving on to alcohol duties. What was your rationale for proposing the RPI-aligned increase in alcohol duties for 2026?
Well, the RPI, the duties on alcohol have been either frozen or below inflation for 5 years. We did think it was time, and clearly there are, as well as the needs of hospitality, the desires of people to go and socialise and use alcohol while socialising, we have got to think about the public health issues. Jersey has a very high level of alcohol consumption, and we have got to bear that in mind as well. So there are very different balances to be struck, but we decided, as inflation has dropped quite considerably from its peak in 23, that this was a time to put an increase. It's not increasing duty in real terms. We are still paying less in total on most things, most alcohol in Jersey than we are elsewhere. It is still cheaper than it is in the UK, I think, generally.
Sorry, do you mean duty? The duty on alcohol?
Duty, I think if you take the combination of duty and if you compare GST and VAT, the cost per unit or whatever is less in Jersey than it is in the UK. If you take, if you're paying 5%, which is, I think, lower than very many other countries, GST, and compare that with 20% in the UK, that is quite a significant difference.
It is, but I mean, declaring I have an interest in this area, but just to provide figures, the pure litre of alcohol in the UK is £32 for a pure litre of excise duty. Add 20% tax at £38.40. In Jersey, it will be £46 for a pure litre, and 5% on top of that is higher. So I make no comment as to what's good or bad. I just wish to provide those numbers as context to the UK market.
I believe that the small distillers relief, Jersey Hospital members have said that has significantly increased profitability. GHA have said they're content with that. I believe that it has had benefit to them. And I can't talk for litres of pure alcohol, but what I've got, 70 cl of spirits, total tax and GST in Jersey of £7.90, total tax in the UK £15 too.
Did you say £7.90?
£7.90, that's with small
That's
distiller
small
relief.
distillers.
Small distiller £7.90, £14.80 in the UK, which is marginally less than the £15.02 in the UK. So for the customer buying a bottle of spirits, they are paying less tax and duty in Jersey than they are in the UK, generally speaking.
Okay, thank you. Can you briefly explain the work and consultation that you've undertaken with industry on the effectiveness and sufficiency of the tap relief proposals?
Tap relief has been discussed at great length, I believe, with Jersey Hospitality, and we do have to. I think we do have to reflect that Jersey Hospitality the Hospital Association does not necessarily speak with one voice. Tap relief will benefit. I think someone did say that, there are a couple of that 90% of the taps in Ireland will benefit from tap relief. So 90% benefiting seems to me to be quite a good impact. There will be establishments that don't have taps that will not have the benefit, but that's the nature of the business model. We are looking at, we have discussed with them, so that tap relief should create it should create a reduction in price if you go into a pub to drink, and that is meant to support. What matters is what the patrons, the landlords, do with their pricing.
Well, that's the rub, isn't it, with the Jersey Hospitality Association,
Yes.
because they would argue that it absolutely will not reduce the price, but we can
I think
come on to that.
opinions divide. So I
Yes,
think
I'm
if
saying
you
there is
ask,
not a
I think if
common
you ask
voice.
in particular the brewers, they're very happy indeed.
But there's-
I think the people who are perhaps less happy are people who only retail bottled
Bottled
goods.
beer, yeah. In terms of the categories proposed to be covered by the tap relief proposals, predominantly the beer and the cider, did you look at any of that through a gender responsive lens?
Yes, we did, and it's not just beer or cider, because you'll recollect that was my first comment on it when this was, we've been talking about this for some time. It will also cover cocktail spirit mixes, cocktails and wines that are sold in large volumes. I think you can go and buy a 10 litre of, if you're buying wine in a 10 litre container, you will have the benefit of tap relief. Now, I don't know if we know what the spread of bottles and large containers are, but
I'm sure that most of the cocktails drunk around this table are not from large containers. They're probably mixed.
next to order.
But yes, we have tried to extend the tap relief as far as it could possibly go.
Has this put any burden onto sort of industry, any administrative burden onto government?
I would say there is some administration which it largely falls on our customs colleagues in terms of importations. There will obviously now be a difference between the importations in large vessels like kegs as opposed to the other. In terms of the burden on the industry, it is largely alleviated by the fact that it is a tap relief. So that the big brewers obviously will have to differentiate between the duty they're being charged on kegs as opposed to the goods they bottle.
Can I just ask, are you attempting to drive changes in behaviour, or do you expect changes of behaviour in the sense that businesses may spy an opportunity to sell lower cost alcohol by using tap relief, by buying bags or whatever and putting things into there? I mean, is that something you've modelled, thought about?
I wouldn't say in great detail. I mean, the genesis of this originally was that ministers were lobbied essentially to mirror what the UK was doing. There was an argument in particular about trying to reduce the cost of alcohol on licence. There was a concern about keeping public houses and so on going as social hubs and so on. So we did look at it very much from the lens of trying to do something that would benefit on-licensed sales. Now that is there, obviously there is an opportunity for people to work with the tap relief to adjust their business models.
You talk about the on-trade and the off-trade, and that's something that was raised with us again by the Jersey Hospitality Association, and certainly they've been proposing about a split duty rate. Have you done any work this year on how that might work?
We are still doing thinking around that. The real difficulty is that if you're a brewer or a distiller, you don't know the end use of your product until it gets to the ultimate point of retail. So you can only really differentiate for tax purposes at the point of retail. And that makes it very difficult to construct an effective excise duty. I think when we look at it in further depth, a more likely outcome is some sort of end-use taxation. So, for example, and I'm not suggesting this is a good idea because we don't really want to complicate the GST system, but a higher rate of GST on alcohol sold in an off-licence, for example. It's very difficult otherwise to construct an effective form of taxation because of the risk of diversion.
And the likelihood is that they will be very burdensome in terms of administration for everybody. You know, so everybody will have a much higher level of administration, including the retailers and and we don't think anybody else does it, which there may be good reason for that. So it would be, I think we've previously thought it would be very
Yes,
administratively
we're
difficult
not
for
aware
everybody.
of anyone that does it.
From a public health perspective then, clearly linking the price to changing behaviour and reducing consumption, have you considered any other alternative approaches to kind of level the playing field between the on-trade venues and encourage safe social drinking environments?
I think that really sits with public health. I mean, there's a limit
Yes.
to what we can do in terms of tax, because I'm not sure. I think there's limited, I believe there to be limited evidence as to what, you know, if you apply minimum price per units, it doesn't necessarily have any impact, and it will impact those on low incomes more than it impacts, you know, the people that are quite happy to pay £10 for a bottle of wine. It will not impact them, but it will impact people who are drinking at the much lower end of the market. So there's where the impact sits, and people at the higher end may be drinking just as much, if not more, than the people at the lower end of the income scale.
Okay, thank you.
So I think it is a difficult. I think there is. I suspect there is very limited steps we can take in terms of tax that would dramatically change behaviour, and I think there has to be a much bigger.
Although there is good international
messaging.
evidence to show that price and consumption are intrinsically linked. To increase the price, the consumption
But how far do you have to in an island where a lot of people can't afford to drink? Why?
Okay, I'm going to move on to you.
Another tax that has been, duty that's been increased after several years of being frozen is fuel duty.
Yeah.
It was proposed as a cost of living measure. Was there any monitoring of the impact it had on cost of living?
Well, as Richard says, it's difficult to monitor impacts of tax. I mean, I think it was also frozen for 3 years to reflect cost of living. Now, I think you can either do something, or you can do less and spend the money monitoring it. I think if people are still driving their cars, it may make it easier for people to drive the cars.
It's a general sort of, it'll make things slightly better for people.
Yes, we are trying to make things slightly better, and we also said as part of the CSP, it was very clear. We said very clearly as part of the CSP that we would endeavour to minimise increases to government duties and levies as much as we could to help the cost of living, and that is the kind of possibly relatively small thing that we can do, is to not increase duties.
But you have.
But there comes a point where you think, well.
So what was that decision-making process? Why have you decided to reintroduce cost of living increase in fuel duty?
Because, well, it's not increasing it in real terms. It's making sure that I think it's an inflationary increase. We're returning to the pre-2023 convention in terms of increasing fuel prices. And also fuel prices themselves have fallen. You know, we saw some peaks after, there were some real peaks in petrol prices. Those have also come down. And we think the diversity of pump prices is such that the duty will have no impact. You know, that you could still go to another garage and pay less than you at your current garage. And we also have to bear in mind that some of this will go into, I believe, into the carbon neutral roadmap. So we've got to think about that as well. You know, there's numerous balancing exercises.
Okay. So on balance, you feel like 3 years of increasing duty was enough, given that fuel prices generally have fallen?
Fuel prices have come down, inflation has come down. It's not come down as low as we would like, clearly, but it has come down dramatically from over 10%. And we feel that this is time to start.
Just on a niche subject, but one I have a particular interest in, which is the HVO, hydrotreated vegetable oil. There was a measure to freeze duty on that, and in fact to cut it, I think, last year. Have you seen any changes in behaviour? What's uptake?
I don't know the answer to that.
I
Do we know?
don't have the
We don't know.
volumes. We can ask for the volumes and let you have those. if
I
that
don't
would be helpful.
recollect them growing. I think there are issues with, there are concerns about HVO and its effectiveness.
And on a similar vein, I guess the vehicle excise duty increases, which have been targeted towards bigger, more fuel high consumption fuel vehicles. Is there any data on whether that has had any impact on purchasing?
Do we know? Do we have data on that?
Not off the top of my head. I can.
I mean, last year, what we did last year was to try to reflect the cost of living pressures and to not put increases on what we might term family cars. But, and we focused the increases at that time on the higher ones. Now, if you're going to spend a six-figure sum on a car, is VED going to dissuade you? I don't know. But as some of that money, I think, goes into the carbon neutral roadmap, isn't it? Yes.
Maybe we should follow up with some written questions, because obviously policies are supposed to have outcomes. So it would just be useful to know.
I'm sure they are there.
We've
We've discussed it, but
So,
I'm sure the environment team will have that data. But I don't know. I don't know it.
They will, and I think a written follow-up may be appropriate, but from memory from the discussions that Com had when they were considering the VED, the volumes of the highest polluting cars seem to be relatively unresponsive to the increases in VED that we've seen. What that means is, though, we're raising more money for the climate emergency fund from those cars, so the polluter is paying for some of the measures
then that you could increase them more. We haven't found the price sensitivity point yet.
I think that is probably fair to say, but then there has to be, well, they've gone up significantly for, again, this year, on top of last year as well. How far you want to go in any one year is absolutely a policy decision to make.
And we do have lobbying from people who like petrol cars, who have got, we've been discussing recently about collectibles and vintage cars, people who want to bring those in, people who want to bring in a camper van for personal use. There are all kinds of anomalies with it, not anomalies, but things that you don't necessarily think about.
Okay, staying on duties, tobacco duty. It's noted in the budget that tobacco duty's seen some large fluctuations with changing behaviours, and it's quite challenging to forecast. So could you briefly explain kind of the challenges and trends you're noticing in tobacco duty, ultimately from purchasers?
I don't have details in front of me.
Maybe
I mean, I would imagine we would all like it to be going down. That would be the ultimate, that it would gradually decrease.
We've continued to see the trend of decreases in volumes of tobacco that is being sold.
Yep.
So that trend hasn't changed. There was a bit of a blip during COVID, which, because it wasn't volumes of tobacco being sold or smoked, sorry, it was volumes of tobacco being
duty-free,
being dutied, as it were. So that the assumption that we've made in the income forecasting is for that to continue, and the government policy of continuing to increase duties by more than inflation continues in that period as well.
Yeah. And that is an area where I'm regularly reminded that we do not, because of, is it WHO or some international guidelines, we do not consult with industry, we do not consult with the producers in terms of when we are setting rates.
The point you make about COVID is interesting, because it did suggest that a lot of tobacco was coming in undutied, and that's why the revenues increased in that period, because there was no undutied option available to people. Does the Treasury worry that by increasing tobacco taxation rates to very high levels, it effectively stimulates an illegal market?
So I think it's more of a legal we think the COVID change was more of a legal, as in people not being able to bring in duty free, which is not illegal.
Okay.
I don't think we've seen any evidence of more illegal trading, but we'd have to ask the customs.
Customs colleagues' general view is that there isn't any significant tobacco smuggling going on.
I discussed it with maybe it wasn't Mel Shaw, it was one of her team.
Okay.
Quite recently about, what are their views on
Well, I mean,
illegal importation,
that-
and they do not believe there is significant
Have there been
illegal
any
importation.
conversations about changing the legal duty limits, either as a revenue raising measure or as a policy measure with customs?
The duty-free limits
Yes.
are governed by international conventions.
So there's no
it's-
flexibility on those?
It's not
There's no
very easy
flexibility.
to achieve a change,
Okay.
and the manufacturers
That's fine.
pretty much
Okay, if that's
produce a
the
standard
position you're taking.
200 box for duty-free shops.
Okay. Another duty or tax is the inching closer to vaping liquids. What analysis has been taken on vaping proposals to ensure they balance discouraging uptake of smoking by those who've never smoked and supporting the transition, but also trying to deter people from vaping, perhaps in the first place?
Well, I think there's been quite a lot of work done. We're following, I think, generally what other countries are doing. We're following international initiatives on that. I think it's very difficult to say if you put the price up. I think the work that Public Health did with young people did disclose that a price increase would deter younger people. So it is trying to set a balance at a rate that will not deter people who are using vaping as a means of stopping smoking. So vaping should, subject to people's usage of course, should still be significantly less than the cost of tobacco.
Are you aware of any impact expected on customs, resourcing, enforcement, being in Treasury?
Customs
adjacent?
it will, if this is accepted, the tax will come in April. Customs will need to do some systems work to develop CSER, is it their system? They will need to do some training, they will need to do some work, they will need to do engagement with, with industry. There are one or two for whom this will be a new development, I believe. But we will be doing that, and that's why it will not come in till probably Q2. We're targeting Q2 because we can't have that work done. The Assembly might say, no, we don't like that idea. So it would not be, we will do that work once the Assembly's passed and
So
it will come in Q2.
The kind of implementation timeline is based on all the feasibility and technical requirements. So kind of that's modelled, and it's not forecast that implementation should take any longer than a target of delivery in Q2.
I don't believe so. No,
That's
no,
great.
we've discussed it with our team and with Customs, and
No,
we
and
think
there-
Q2 is realistic.
And there is a provision for the expenditure in the budget. It's
Yes.
in the Home Affairs.
And it changes. Someone has asked me, is the change in income because you're going to massively increase the tax in year 2? No, it's not. It's just because year 1 will be a
full year.
partial
You'll
year,
have a full
and
year.
year 2 will be a full year.
Okay.
But we're
That's
not
fine.
anticipating an increase in year 2 already. That's certainly not the thinking already.
Okay, one more duty is stamp duty. Could you explain the rationale for the revised stamp duty forecasts, including that reviewed 2025 increase and the 2026 reduction in forecast?
The stamp, no, I don't know, I've got stamp duty somewhere, which I can't find it. I think the stamp duty for this year generally was positive. We thought that was a positive outcome. And we are reducing the second home stamp duty, proposing that by 1% as being an affordable reduction, and also recognising what we're hearing in the market.
What analysis supports that decision?
Well, I think sometimes it's about what we're hearing in the market, about the downturn in sales. The market has been slow, so it did clearly the increase, the 3%, obviously coincided with interest rates going up, but the market has clearly dampened. It is beginning to rise, which will boost stamp duty numbers, but it is reflecting the fact that what we're hearing in the market about people being deterred from buying
I think
and building.
some people would
because-
say the market is asking for no surcharge anymore. So what's kind of provided the policy position to make it a 1% and not say a 2% reduction from the current
Then of
surcharge.
what we think was affordable.
Again, I'm just curious in the analysis, because if the market is saying that a reason for a reduced turnover is the surcharge, what analysis shows that actually reducing the surcharge reduces stamp duty rather than increases total take based on higher movement? Is
should
affordability
do
the
if-
analysis,
if
or is it,
by-
or are there other policies still at play here that you're
If
weighing
by
up?
reducing stamp duty you increase the volume of transactions, you will increase overall stamp duty as the underlying. Did you have more on that, Andrew, that you can add?
So I think it's important to note that when we look at stamp duty forecasts, we're very much informed by the FPP economic assumptions, both in terms of what house prices will do and what housing transactions will do. So that is the basis for the forecast that the income forecasting group looks like. The income forecasting group looks at in drafting that forecast. So that's why you've talked about drops in 26 and 27. Some of that is driven by what the FPP are now expecting the housing market to do. 2025 has increased, and since the budget, we've seen another quarter's worth of stamp duty data. We're currently looking like the forecast that is in the budget, which was elevated from in the previous budget, is not looking unreasonable, I think it's fair to say. So it does seem to be that there is more activity in the market. However, the FPP were cautious in terms of what that meant in longer years, and we're continuing to heed that advice. Whether or not things change in the market will come through in later sets of economic assumptions.
Yes, leading on from the Deputy's question, I mean, the headline news on BBC News 2 nights ago was the coming to effect in the UK of the renters bill, designed to improve tenants' rights, and the correlation to that was the suggestion that landlords were going to sell. Now, that was much in evidence when this panel did its scrutiny review of the legislation here. How closely are you following that particular aspect, and what channels of communication are open with the professionals on that?
I think some of that will sit with housing in terms of the impact on the market. I think
It's an extra ingredient into the equation, what I'm getting at.
Far, my recollection, and it's sometimes I've seen these figures, my recollection is that the number of rental properties that have, I mean, the Landlords Association, various landlords have been saying it's all doom and destruction if you bring in this law. But I think the most recent figures before that debate said that we had only lost, I think it was in the teens, it was less than 20 rental properties seem to have come out of the market. Now, that's not suggesting a collapse in the buy-to-let market, but it has slowed, and it may have slowed partly because of that and also partly because of interest
It's a more general
rates.
question. I mean, the law's not yet been fully implemented here, and just want to make sure that there is a channel of communication so that you're alert to that for possible review.
We see stamp duty figures as they go along. I mean, we will see, how often do we get them quarterly? They will come through.
They come through, yes, from the courts quarterly. We do keep tracking from a financial point of view as well. But.
Okay, thank you.
I'm intrigued by Mr. Hackwell's comments about the most recent figures, which show that revenue is stable on stamp duty, or even potentially increasing. Does that include in the rental market? Because if it does, why would you need to cut the duty to stimulate the market?
I was just asking my team for what the latest numbers were. So it is a financial number. It's not based on the transactions from the court, which we haven't yet had for the last quarter. So when that information becomes available, we'll be able to look in more granularly about what's driving the changes. But in terms of delivering to the £50 million forecast that the budget assumes, that is looking like it should. Well, who knows? The last quarter may be different, but it looks on track to be delivered.
Could I just kind of conclude on this section from what Mr. Hack was saying, that the finances isn't the need for the change here. The stamp duties model is stable. To what extent is this area of policy owned by the Minister for Housing, and is he in full agreement that this is the right step to make?
I believe so.
So yeah, okay.
Future taxes, the fuel duty replacement work was stopped on that on the grounds that revenues had not declined as much as people thought. What's the current plans in terms of fuel duty replacement? What work is being done on that, to what schedule?
Well, we had started work on that. It had begun, and it's not necessarily an easy thing to do. And when we've looked at the figures, the amount of fuel duty has not, I think there was a kind of assumption that fuel duty would gradually just plummet. And it hasn't done that, although there is a decline. The decline is much less rapid than we expected. So we've been focusing on other things. When we have the work we've done isn't lost, it's there. It's a very difficult thing to achieve because you either go for a per vehicle charge, which, you know, if you are, the example is Mrs. Smith, who lives in St Wans, who drives into town once a week, she's penalised more than the person who drives every day in their car. If you want to go for a usage model, we then need to bring in technology and get everybody to install technologies in their car, and that, you know, that will be mind-blowing.
Work is still paused
for people. So it's still paused at the moment because fuel duty is broadly holding up. Or it is not in such a rapid decline as we expected.
So it's another thing you're handing to the next government.
Well, it's something that will, well, we can do work that's unnecessary, or we can focus on things that are more important. It's doing something, it's addressing a problem that doesn't exist as yet. The work is there, it will continue. I'm sure
It's
the
always
team are
good to be ahead of the curve.
to monitor that it is still in abeyance.
Okay.
I believe, isn't it? Yeah.
So from a policy perspective, the work was done to get us
To get what, sorry?
ahead of the curve.
Yes.
It's just merely prioritising, taking it beyond policy work into greater implementation understanding. That was paused, so it's not lost.
The carbon tax on private aircraft was effectively also paused because Ports of Jersey did their own charge. Have they done any work with you, or have you done any work with them, to look at about the effect of that in terms of decarbonisation?
I can't remember. I did see something about it recently, and I can't remember what the outcome was. I think their charge has been introduced, but I just cannot. I can't remember what I read. It was a few weeks ago, and I can't remember. But they are doing that, and the money there will go into their decarbonisation initiatives. I believe they are doing very well. I think they've been nominated for various green sustainable awards in the industry. They are doing very well towards their targets, is my recollection, but I simply cannot remember the detail.
Given they're now taking forward that piece of work, at least for their area, and that's in train, have any conversations during that time also looked at other parts of where their estate is, such as private yachts over a certain size, by your department?
No.
No.
But extending that thought further, what about marine diesel?
We have had I recollect that we had a discussion about that, but it was discounted for numerous reasons. It has not been continued for numerous reasons that go into the economy. That we have boats coming into Jersey, spending money in Jersey that would stop coming into Jersey if we increased prices. There are wider impacts in raising.
Has that actually been analysed, or is that just a piece of folk wisdom?
No, it was considered and discounted at the time.
Okay. Pillar 2, the OECD tax reforms. Mr. Assistant Minister?
Yes. Thank you, Deputy.
I wondered whether you could tell us anything about the forecast revenues for Pillar 2 now that we are getting closer to the implementation, whether you have any updates for this new tax, corporate tax.
So we may be getting nearer to the end of the financial year in which liabilities arise for in-scope companies for Pillar 2, and and Treasury Jersey have been working hard to ensure registrations, and that process is happening. They're also working on the technology more widely for payments to be received. The base case scenario remains as is in the budget, and the reason that I can't give you any further certainty is, of course, because post the G7 declaration that they would like to see the US regime sitting side by side with the OECD regime. There's been ongoing negotiations between the US and the OECD, and those conversations are ongoing, and they're not yet all of the detail of how that will work and the implications of that are not yet finalised.
Okay, so the base case scenario you still feel is you're confident in. What measures are you taking to ensure that those funds, when they come in, are reserved for measures that are not longer term recurring spending? Because on the assumption that this cannot be guaranteed as a long-term funding source.
So there's two different things here. If we remind ourselves broadly, the base case forecast is from banking groups who I think we would expect to be stickier within the jurisdiction and therefore are more certain, and to a large extent shouldn't be impacted by any future side-by-side arrangement. The side-by-side arrangements would impact more on any.
Oh dear.
Are relatively confident that the base case provision will be maintained, and you see from the budget what the allocation is of that base case. There may, of course, be some finessing around the edges of that. That will depend on, as I say, the outcome of that side by side. But our best forecast and guesstimate at this point is that any side-by-side agreement would impact the upside rather than the base case.
So are you comfortable then that the base case revenues can be relied upon sufficiently to become part of business as usual government revenue?
Bearing in mind these are forecasts, bearing in mind the no final agreement has been made around side by side, I think I'm as comfortable as I can be that base case forecast will continue to be appropriate, certainly for the lifetime of this plan. And I'm not just taking the 1 year, I'm taking the lifetime of the plan, the rolling plan. But there, as I said, there may be some small implications around the edges, but I think because we took a prudent approach from day one in the way we calculated the base case, I think we can continue to be confident in that. But there are still these moving parts that may impact it.
Okay. The extra revenues then that you come in, you have no sense yet, the additional revenues, you have no sense yet of how big that would be?
Well, we would simply really be lifting our finger and putting it into the air if we tried to calculate that. So I don't think it's sensible to do that. However, because of the side-by-side agreement which is seeking to be reached, I think the only thing that we can say is it would be very prudent for us, if and when that upside occurs, to ensure it is only used for one-off purposes or in that specific way,
Okay.
it would not be appropriate nor prudent to seek to allocate it for ongoing expenditures.
So the base case money becomes part of, is a £50 million windfall effectively for government. The upside money should be reserved for one-off expenditures or time-limited expenditures.
Yeah, and the budget currently talks about upside monies being used to support the hospital. We are having, let's just say we're having ongoing conversations about, okay, so used to support the hospital, that currently would seem sensible, but there is an argument that could also say in changing economic times, you could also argue that any upside should go into reserves. I would personally argue, of course, and I've not been here for the whole of the hearing, for which I apologise, but there is a need for us, and I think Deputy Kirsten's asked this question about the economy and diversification. There is a need for us to support the economy in times of global instability in targeted one-off manners.
Okay, thank you very much. Minister in the room, if I could just talk about the total revenue expenditure for a moment. Total revenue expenditure continues to grow through the plan period. How does this square with the aim to try and contain the size of government?
We are still trying to contain the size of government. I mean, there will always be things that we have to spend money on. Health, education, all these kind of things. But we are still trying to curb growth. There will be various initiatives. There will be we are talking about that at COM. That will feed into an all-members workshop in February, where we talk about various things that we could do to reduce the size of the public sector, which has grown dramatically. And that will go beyond reducing our spend on consultants, reducing unnecessary management. There are some proposals as to how we take out layers of management, which will be discussed with all states members in February as that thinking all comes together. But I think essential services, they are still there.
So in terms of that goal, it's just not possible.
It depends how far you want to cut. I mean, if you think we can cut back office functions, if you like, what are the things that we don't really need? What are the essential services? So we don't want consultants, we don't want unnecessary layers. If you start cutting services, that will be, what services do you cut? Because that is the next option. Actually cutting services, and it'll be 5 minutes before somebody's jumping up and down shouting austerity. So how do we are trying to reduce spend, and there are elements of government that we are looking at how we can reduce those elements. But at the stage, those are not in a position where I think they can be, they are not sufficiently advanced where you can say we will save by doing this, because it has to meet general agreement and it will then feed into future years' budgets.
Could I
But
ask?
I think we all have to agree that we need to try to stop spending or to stop the growth in spending, such as creating new bodies and giving them independence. And
There's a narrative, and I think it would be fair to say it was earlier in this hearing, and other leaders within the civil service and politicians are saying spending has dramatically increased. And there's now a narrative saying we need to cut spending, we need to reduce the size. Why is it so hard to pinpoint which recent spending that's increased is suitable for cutting or suitable for degrowth?
well, I think you have to, I think it really comes down to what are the essential services that government has to do. I mean, is there overreach in government? We are behaving, is Jersey, which is a small jurisdiction with relatively low tax, behaving like a large jurisdiction with 45% tax? And we keep creating bodies and structures that are perhaps not suitable for Jersey because people think, let's do that. Every time we sign up to a convention, that creates a cost. It does create a cost because it creates work that we all have to do. So, and I'm not saying we're going to come out of any conventions, that's not what I'm saying, but I'm just saying, for example, every time we set up an independent body, that is a cost. They start off with, we'll set up this body, it'll be one man and a secretary in a cupboard somewhere, and before you know it, they're in big glossy offices with a huge staff and the wage bill has trebled.
It's just there's a very strong narrative that growth has been too fast and unnecessary, and it feels like that's being backpedaled and said that's the wrong thing. But how is it prudent to have that message if it can't be pointed to which growth was too fast and unnecessary? Is that the right way to go about addressing the cost and the size of the finance?
I don't think we're saying it's too fast and unnecessary. We're saying there has been growth. There has been growth, and we need to really stop and think about, when we introduce various mechanisms, various bodies, are they the right things to do? And those are not. It would be absolutely inappropriate for me to start to point to certain groups or bodies or services, because that will create uncertainty in that group or body or service, and that's not right. These things have got to be discussed, they've got to be agreed, and they have to be communicated properly to politicians, to our colleagues, to our staff, to the employees, and to the wider public. And we can't just throw things out and say, well, we're going to stop doing that or stop doing that, because it will create anxiety and uncertainty. So it's not that it can't be done, but it has to be done in a careful and considered way.
Thank you. I'm going to move on.
And still on the question of growth of spending, one factor must be inflation. So my question is, to what extent have inflationary pressures, including domestic inflation, affected government spending in 2025 and being considered in the 2026 budget?
So in 2025,
Well, yes, to what extent have they, was inflation last year considered in relation to the 2026 budget?
so when looking through the budget, inflation provisions are made in two ways. Pay provisions are generally held centrally and then issued to departments once the actual amounts are known. So the 2025 pay award has been funded, it's been given to departments, and that has now been reflected in their base budget across the period. There are also provisions made in the central reserve based on, for 2026 it is based on RPI plus 1% in line with the already agreed pay deal. For future years it is based on RPI, which was the preceding policy. Obviously that's subject to agreement both politically and with the unions, etc. We also make provisions for non-pay. That's been allocated to departments in 2026 based on the FUP's assumption for inflation, in the same way that in 2025 they received inflation in line with the FUP assumption. So departments should have had the provisions that would allow them to keep their costs, meet the inflationary costs in both 2025 and in future years.
You've answered my next question in part, which was, how was the 40 million plus allocation for inflation calculated and distributed across departments, and what contingency plans exist to manage higher than expected inflation?
So staff pay inflation is based on what we expect the staff budget to be, times by the appropriate inflation rate, similarly with non-pay as well. When we look at non-pay, we do also bear in mind the policy of not increasing fees by more than 2.5% without approval. So we do limit the amount that income in departments would go up. So that is factored in. There is a detailed calculation that's used, but it is all based on FPP assumptions.
Okay, thank you. And then what consideration was given to the impact of inflation on businesses, and particularly what support, if any, does this budget provide to those businesses where support is needed?
So the provisions for government inflation, well, I suppose you could argue that by maintaining spending power of departments in real terms, that helps businesses in that spending power hasn't been cut in real terms. But it's designed to make sure that departments can continue to afford to pay deliver the services they're currently delivered, rather than being aimed towards businesses. It will be a sort of a secondary impact, I suppose.
And to explain to a layman, can like me, I mean, can you outline the process for contingency funding in 2026, and when such funding will be available, and from where?
So in 2026, the inflation provisions, so for pay, for example, we've just had the September RPI come out this morning. That is the number that will be used to drive the payroll for 2026, and the provision that is made in the plan should be sufficient to meet those. So pay, which is our biggest amount of spend, will not be an issue. In terms of non-pay, the amounts have already been allocated to departments. If they see inflation, and this is always a feature, not everyone suffers inflation equally with RPI, but without maybe hiring several extra people and adding to the growth in public expenditure to track absolutely what a government RPI might be and how different departments are impacted, we use RPI as sort of an average that departments get. So some departments do occasionally come through a budgeting process we've seen before where there is very high inflation on certain things. They will provide evidence to that, and that may mean that it's appropriate to use some of the contingency funding the Treasurer referred to earlier. So we do hold, I think, 5 million in the reserve for unforeseen items as well.
Yeah, to take for example, the fishing industry are concerned about the spiralling costs and have indicated that some fishermen might go under. So that's a contingency which may well come about. You're saying there's a process by which fishermen could be assisted in that respect?
No, I think we're confusing support for businesses and internal
government.
allocations of inflation for department. They're two different things. Support for business. The support for business in this budget is obviously through the economy department's budget, and in particular the second tranche of £10 million for further better business support package. That's in the budget as it was in 2025. What Andrew was talking about related to inflation within departments.
Okay, so that way I take the point, it's a different pool then. Okay, thank you.
Thank you.
Borrowing. How is the state managing its borrowing prudently? And in particular, how is it deciding how and where to borrow, such as the use of fixed or variable interest rates and the use of the revolving credit facility?
So currently, we are using, as you point out, the
Revolving credit
RCF.
facility.
revolving credit facility, yes, to meet borrowing. That's part of the strategy we have in place. We are meeting often with those entities who helped us with our issuance in the past to look at rates. Of course, the market isn't particularly going in the direction we would like it to be going in at the moment in terms of the cost of borrowing. We are comfortable at the moment. We continue to use the RCF until such a time as we need to go out for sizable amounts of borrowing. That's leading us to consider whether we might go out for shorter term debt compared to the very long term debt we've issued in the past. That might be 5 to 10 years, as and when we get sufficient quantum of borrowing need, we may, instead of going for the very long debt issuance, postpone that and use bank term debt in the meantime. So we keep that under regular review.
Okay. New healthcare facility funding has access to the revolving credit facility and is hoping to be in part then funded by receipts from Pillar 2.
Yep.
There is a model that further drawdown from the strategic reserve could occur if there's uncertainty over that. During 2025, modelling into 2026, what's the impact on the strategic reserve if that drawdown of 277 million has to come out of the strategic reserve? And what kind of assessment has been taken of what might happen there?
So we'd undertaken that when we first established that policy back last year. Much of that hasn't changed by the size of the strategic reserve, notwithstanding the fact the strategic reserve benefited from the investment returns over that period. As indicated in the conversations, still uncertain in terms of what that upside might be, but as clarified by the Assistant Minister, plan A is to use that upside for that instead of drawing down on the strategic reserve. So plan A is still to use whatever we see on the upside, and we will know more come March, May? End of May next year.
But for clarity, in the budget, the estimates provided for the strategic reserve assume the money is taken out, even though that's not Plan A. We have used that prudent position. So the balance in strategic reserve is after the money
The drawdown.
assuming
Assumed
the drawdown, even though that's not the preferred option. The other point just to make as well is that by the end of this year we will have transferred across the remaining, well, the right to the remaining amounts from the prior year basis taxation, so it was about 290 million. So that action increases, following the state decision last year, increases the amount of assets in the strategic reserve, although as the FPP have highlighted, it's not necessarily cash, it comes in over, say, the next 20 years. So
Can you provide an update on the borrowing arrangements for Fort Regent, as well as what other options for the funding of its redevelopment were considered?
Yeah, once we've had the budget approved, we will revise our debt strategy accordingly. Given the size of the borrowing relative to the borrowing for the hospital, we'd expect to just roll that up within the strategy for the hospital on an ongoing basis. So we'll use the RCF in the short term as and when needed, and then as we chunk it up into bigger amounts in the long term, it would form part of that borrowing.
Why was borrowing using the RCF the decided model for Fort Regent?
Why?
Why? Yeah. Why choose to borrow to redevelop Fort Regent, and why use the same model of the RCF? Not well. I mean, you've said that's your current model for borrowing in the current climate. Why borrow for Fort Regent?
Why borrow for Fort Regent? I would suggest that given the options, so the options are: do we have the available funding without borrowing? Not unless you eat into reserves yet further. That there is a plan in terms of how we would go about funding that. It's built into the budget for 2026. So given your options, your two options would be to draw down on reserves or borrowing. We favour the borrowing.
The proposed borrowing of, I think, 43 million is only to cover phase one, which is weather-tight, watertight and safe. There is a full business plan. There is a predicted amount, I think, in the public domain of circa 110 million to develop Fort Regent. And one would expect some of that work to be carried out in 28 and 29. Why is there no allocation to the delivery of phase two, given it's more than likely to be something that follows phase one and therefore would exist within the life of this budget?
There may well be options for different financing for phase two, once phase two has finally been approved. In any event, short of pulling down Fort Regent 2 rather than the original Fort Regent, in terms of making the site safe, most of that expenditure is necessary to progress with Fort Regent in whatever model it is in future.
So the question was about the second phase.
Yes, the second phase is there could be other opportunities, including using partners for the development of phase two. We would bring forward whatever the funding is, probably in the next budget.
But it's interesting that, for example, the hospital, we knew there'd be budget requirements over 4 years, more than that, and so the budgeting in debt was there. It was in the plan to know that it would be a liability on the government. Why, in the case of the fort, knowing that there will have to be a phase two of some form and it will almost certainly want to be delivered during the budget period, is there no money in the budget for what is almost certainly a piece of capital delivery by the government?
It's not currently in there for future years. At the time at which you enter into a contract to build a hospital, you need to know that the funding is in place for all of what you're entering into a contract for. In order to do phase one, you need to know, as an accountable officer or third party, whichever is building it, that you have in place the budget.
So you don't need, we don't, because we didn't need phase two in here, we didn't put it in?
Yeah.
Okay.
Thank you. I'm just conscious of time. We've only got 5 minutes left. So we still do have some questions around kind of states funds and other elements, and we'll put those into writing if that's okay, possibly with a short turnaround date so that we can prepare our review. So really, last question, I think, is largely around the consolidated fund. And this budget proposition proposes that 50 million be transferred from consolidated fund to the stabilisation fund in 2026 based on availability of funds in the consolidated fund. But we've seen in recent years that the consolidated fund is usually in a cash negative position. previous year's proposal to transfer the 25 million wasn't available to be transferred, so that never happened. So Minister, really the final question, how confident are you that this transfer that's proposed of 50 million will be possible in 2026 if it wasn't possible to transfer the 25 in 2025?
That depends on how ministers manage their budgets and accountable officers manage their budgets.
In terms of upside income, it's a provision in place for utilising that upside. How confident? I'd be absolutely delighted were we to get to that position. The only possibility I think of getting to that position would be through Pillar 2, but nevertheless we have that in there as a contingent measure that the Minister can take to make sure that that funding, should it be there, is prioritised to, if you like, building back up the stabilisation fund in a way that previously, if you don't follow that route through, it just forms part of the consideration of a subsequent budget and isn't prioritised towards rebuilding the reserve.
So stabilisation fund will remain depleted, in other words. Can I just ask if there's any final questions from the panel?
Sort of a context one, I guess. I mean, you've got taking 15 million from the Social Security Fund contributions and you're getting 50 million from Pillar 2. So there's £100 million a year uplift in income coming into these budgets, and yet still the budgets are struggling to balance. Does that give you any cause for concern?
Pillar 2 has been allocated towards, well, we know what that's been allocated towards, which is principally capital, isn't it? Capital and reserves. So that is not going towards revenue spend. And as I've said, we do need to work on reducing the size of the public sector, but that really requires everybody to work together.
But it's almost a 10% increase in revenues coming in, or available to spend, I should say. And that's the sort of money that...
No, the Pillar 2 is not being applied against revenue spend. We're doing something different with that. And if you're talking about the money from the Social Security grant, that is being applied on a temporary basis. So we still need to do work generally to reduce spend. You know, that is not necessarily, as you said, a continuing pot of money for revenue spending. Because if people did think there was a pot of revenue spending 100 million, it would be spent next week. So,
Are you as a Treasury Minister happy to be handing this problem to the next government?
we have a solution for the next 4 years, which is temporary, and we have a plan. We have a plan as how that will be delivered.
Would you say spend and pray?
No, I'm not saying that. I think we are trying to do everything we can in terms of allocating money to capital and making sure we have money for revenue. But sooner or later, as an island, we have to think about what we are spending money on. And we cannot keep copying everything that they're doing in every other part of the world like the UK. We cannot keep creating structures and spending while we maintain low taxes.
Thank you. Conatav Johnson, did you have any final questions?
Thank you.
Deputy Curtis. Right. Okay, on that basis, with a couple of minutes to go, thank you very much, Minister, for attending our hearing today and for addressing the panel questions, equally to your officers. There are a couple of points that we will follow up, as I've said, in